Hi everyone, so in this video I would like to explain to you how drawings work. The owner may want to take out cash out of a business for his private or personal use. That is one way in which drawings will be used. This is known as drawings. Money taken out as drawings will reduce the capital account. It is very important to note that in addition to money which the owner can take out from the business, the owner can also take out any other asset from the business itself. Each amount taken as drawings will reduce the capital account. Eventually, this drawings amount will be transferred to the capital account. Let me explain the pointers I just read to you, giving you a couple of examples. So the first transaction is August 1st, 2017, started business with $10,000 cash. For this particular transaction, we would need to debit cash, and we would need to credit capital. Of course, at this point we understand that cash for the business is going up. That is the reason why we have a debit entry on this particular T account. And then capital is also increasing and we did a credit entry on this account. August 15, the owner takes out $200 cash out of the business for his personal use. So basically what is happening here is that the owner, who is the investor in his business, is taking out some of this money from the business, which he has every right to do so, but we need to make sure that we have a proper record of this drawings that is taking place. So if the owner is taking out some of the money that we have available at this particular business, we need to first of all reduce the cash account. So we need to do a credit entry on the account cash. So this lets you know that cash is being reduced, and very important for us to also note that we need a debit entry. So in this case we will need to debit drawings. So this transaction right here takes care of the other side of this transaction. So first we did a credit entry on the cash account and now a debit entry on the drawings account. Every time the owner withdraws money from the business, we do a debit entry on the drawings account. Again, as I said previously, very important for you to note that the owner can also take out any other form of asset from this business. So if the owner were to take out inventory, then we need to make sure that we do a debit entry on this account. Eventually, all the transactions that you enter on the drawings account will be entered on the capital account, or rather they will be transferred, but that is something that we will deal in future chapters. For now, note that whenever you want to, in quotes, reduce capital, you do not do it on this account. Instead of reducing the capital account directly here, you need to do a drawings account such as the one I created here. A common trick I've seen my students use when I first introduce the drawings account is that they say every time you use the drawings account you will debit, because the first two letters of the word drawings is DR. and capital, you will always do a credit entry because of the letter C, a pattern that perhaps doesn't work always, especially when you know how to use these two accounts properly. um, by that I mean that eventually these transactions will be transferred to this account. So perhaps at the beginning it is a good pattern to look at, but the best way for you to learn how to use these two accounts is to learn the rules properly.